All right, well, I think we could probably get started now. Well, welcome and thank you for joining us today. If you have any questions at any point, please use the Q&A box located below. Our team will do our best to answer your questions live. However, if we're not able to get to your question, we'll be sure to follow up with you afterwards. Also, for your convenience, we are recording this webinar. All right, for those who may be unfamiliar with Sensiba, we are a leading accounting firm ranked in the top 100. Our services encompass tax, audit, and a broad range of consulting services, including technology and sustainability solutions. We take pride in being a certified B Corp and have been serving our clients for over 40 years. Okay, so before we kick off, I'd like to go over some housekeeping. To receive credit for this course, it's important that you actively engage by participating in at least 75% of the four polling questions throughout the webinar. We will have each poll up for 1 minute, so please be sure to lock in your answers. Additionally, for full credit, you must attend for at least 50 minutes. For internal attendees, please complete the course evaluation for the training and provide feedback post-webinar. If you have any tech issues throughout or missed polls or anything else regarding your participation, please communicate with us to get this resolved. And then finally, your credit will be issued within around 2 weeks of the training date. All right, I'm pleased to introduce today's speakers, Kolmar, partner and leader of our R&D tax credit practice, and Ariane Woods, senior manager and co-leader. Each bring 20 years of experience with engineering backgrounds, and together they have guided many companies through the R&D tax credit in Section 174. Today, they'll share insights on HR.1’s changes to Section 174 and qualified small business stock. With that, I'll turn it over to you, Cole, to get us started.
Thanks, Louie. The 20 years of experience thing still surprises me, but happy to be here and hopefully share some of that. We're happy to be here today. These are some very timely points and then some really timely information I hope that we're going to share. So we're also already launching the first poll for everybody. So if you want to go ahead and answer that poll, be the first one on your path to receiving the CPE credit for today. So you see poll 1 should have popped up before we're really getting going on the learning objectives here. Please go ahead and answer that poll if you're interested in CPE. So the learning objectives for today are to understand the key changes to HR1. And I'll take a moment to pause. We're going to try to refer to it as HR1. This is also referred to as the big beautiful bill, OBBBA, in a couple of places in this presentation. I mean, endeavor to just refer to it as HR1. So I'm reinforcing that for myself as much as anyone else. But so we want to talk about the changes that HR1 made to the Section 174 capitalization requirement. We want to describe the approaches that a taxpayer might use to transition that R&D capitalization. There's a couple of different things depending on the type of business that you are and how it was defined in the legislation. And then related, but on a different topic, we're going to discuss qualified small business stock, Section 1202, and some of the requirements, what is changing and what remains the same post HR1. And then today's agenda, which is close to the learning objectives, but we're required to have an agenda and learning objectives for CPE. We're going to talk about what's changed, what are your options. Importantly as well, I think the factors that should be used in planning. So we're going to try to put some context within some of these points, right? It's easy to say eligible or qualified small business can do X, but we'd like to hopefully go one level deeper here. With a few examples, et cetera. And then the qualified small business stock section, we're going to define it, talk about how it's changing, and again, try to just add some context, what factors should be considered, and what you should think about doing to make sure that you're protecting that QSBS status. So without further ado, why does Section 174 matter? Well, Section 174 matters because there was a big change in the 2017 Tax Cuts and Jobs Act. Previously, taxpayers in the United States have been able to expense in the current period their R&D expenditures. Section 174 existed. It's related to the R&D credit and a couple of various other things, but taxpayers always had the option of a current year expensing. They were allowed to capitalize and amortize those Section 174 R&D expenses, but practically speaking, nobody ever really availed themselves of that opportunity, right? Because people preferred to have the current year expense. Well, in 2022, it created a massive impact when all of a sudden this change that was made in 2017 actually went into effect, and companies were required to quantify their Section 174 expense, capitalize and amortize it over a period, depending on whether it was domestic or foreign. This created unexpected or maybe underestimated cash flow impacts, tax liability impacts, somewhat related there. We saw in our client base that it really impacted certain types of clients' R&D investment and their R&D planning. And then an under the radar impact that affects the qualified small business stock is it had the impact of creating a larger gross asset balance for some types of companies that was then beginning to potentially impact their qualified small business stock status. So those were really, you know, large things that were impacting our clients because of this Section 174 capitalization change. And then, you know, near and dear to Ariana and I's heart is, you know, the interaction of Section 280C and reducing the credit or not. It was a change in the way we thought about how these credits were accounted for in the tax return. So that was an impact as well.
And just for convenience today, we're going to be referring to all of these expenses as R&D. There is different language used for the different tax credits and Section 174 and just some of these other issues, but for simplicity, we're going to call them all the same thing today. We know that that's not technically correct, but it is much easier to keep everything straight if we just kind of consider them all approximately the same thing.
The IRS will tell you it's research and experimentation. Anyone who has not been corrected in that direction by the IRS hasn't really lived as an R&D tax expert. So as we mentioned, those changes from the TCJA created a delayed impact. Digging into a little bit more of the detail, what was that delayed impact? So the companies were required to capitalize and amortize Section 174 R&D. Domestic R&D, right? R&D that was done in the United States had a 5-year capitalization period. Foreign R&D, right? We have people with, you know, run a U.S. operation that have Canadian contractors, or a lot of our clients have European software developers or things like that, required to capitalize and amortize that over a 15-year period. But it was actually a little bit worse than the headline of 5 years because there was a mid-year convention, which means in the first year, you only received 10% of the expense as deduction in that year. The other 90% had to be spread over the remaining periods. So this was especially painful for potentially profitable technology companies, manufacturing companies, especially. We worked with, I remember having a conversation with one software company that hadn't taken on any funding, and they had sales. They had $1 million in sales, and they were planning on bootstrapping the company, right? So they had $1 million in sales. They were going to reinvest $1 million in R&D. Well, they had to change their plans because all of a sudden they had $900,000 or about that of taxable income, but they had already spent the money. So
yep, and that's about a $200,000. That's about a $200,000 tax bill.
Right. So then you think, how do we get there? I think Ariane's going to cover this graphic in a little bit of detail, just to refresh. Right.
Yep. So the R&D credit has 4 main components. There's the wages, the taxable wages of the personnel that you're paying to do R&D. There's the supplies that you're buying, and that includes computer rental. So software companies tend to have a lot of cloud costs as well. and you can take 65% of the contract research, again, US based. When you look at the footprint of Section 174, it's the R&D overhead, so those considered costs incidental to R&D. So not just the wages of the taxable wages of the people, but the gross wages and then the burden. So the employer side of the taxes, the 401k contributions, health insurance, the supplies that they're using that you wouldn't, like the desk supplies that you wouldn't include for the R&D credit, but you include those. Not just the patent filing fees have a bigger footprint. Anything that's software related, they're just like, hey, in with that, we're not going to have any of these conversations we've been having on the R&D credit side about software development. If it's software development, it goes in. And then you don't get the 65% haircut or the 35% haircut on contract costs. You actually include all of it. For a lot of our clients, we were seeing 15 to 80% increase between what you include as Section 41 R&D credit expense and what 174 was picking up. So you might have $900,000 in what you're counting for Section 41, but that's $1 million in 174. Or for some of our clients, it was $2 million because they had an international footprint. And so especially when everybody thought this was going to get fixed prior to going into effect in 2022, it was a really, really nasty surprise for a lot of people.
The other thing to recall here as we're setting the stage is that the Section 174 capitalization was a requirement in the tax code. The Section 41 R&D tax credit was something that a company can choose to avail themselves of or not. So that was a dynamic that people really had to wrestle with. It's like, well, even if you're not taking the R&D credit, in theory, you should be evaluating your expenses to figure out what needs to be capitalized under Section 174, because while they do overlap, they are different potentially sets of expenses.
But it gets better.
It gets better. So the good news, what's the good news, right? This is the overall headline, the good news. So HR1, before I give you the good news, I see poll 2 just popped up.
Yep.
So if you want to take a second to answer that, if you're looking for CPE credit, what we'd like to know is, do you have any international R&D expenditures in 2025? So yes, no, not sure. So
for all of our internal people, we can just answer no, we're not sure. And again, correct answer is not required.
Yeah, no correct answer required, but
yeah.
Okay, so HR1 provides a path for immediate expensing of domestic R&D expenses, right? This problem that we just queued up from 22 to 23 to 24, right? All of a sudden, when we move to 25, we no longer are required to identify Section 174 expenses, capitalize and amortize them, and go through the headache and all the problems.
For domestic expenses only.
For domestic expenses only. So there was a lot of excitement when this legislation first passed, because people read immediate differently than maybe the intention was, right? As I joke, in the direct context of this bill, immediate meant 2025, the year in which the world is living, not 2024, the year in which a lot of tax professionals are still living. So important to remember that. But I think this change in some ways was expected, that was expected every year for the last couple of years. But Congress responded to industry pressure and to the fact that it was really creating a disincentive for R&D in the United States. So very happy that this has been fixed. Now we need to figure out, how do we unwind some of the prior capitalization? What do we need to do? What can we do? One thing that is clear, though, is that the foreign research component and requirement to capitalize over 15 years has not changed. So for foreign R&D, it retains the TCJA treatment, continue to capitalize, and that is a permanent item, right? There's no sunset on that. It doesn't automatically revert in any way until such time as there's additional legislation that changes it. It's a permanent fixture in the tax code now. So what do we do with unamortized amounts? So if there's a path to no longer capitalizing this, what can we do? So unamortized, previously capitalized amounts you have a couple of options. Option one, you can keep the existing amortization schedule. If you'd like to just run it out the way it's set to run out, that's perfectly acceptable. The exciting option, I think the option that most companies will take advantage of, is that you can accelerate amortization fully in 2025, or you can spread it across 2025 and 2026. I think most companies will choose 2025. There are some interesting edge cases, we'll call them, where you might choose 2025 and 2026. But I think the overall, the most common option will be 2025. So any company can make the choice on option one or option two. If you're this category of business, which they call eligible small business, you have a third option, and really a couple of third options, if that makes sense. So you can amend, potentially super exceed, to undo, if you will, Section 174 for 2022 to 2024. So the most common and maybe the most straightforward way would be, if you haven't filed your 2024 return, you elect to expense in 2024, that is okay. However, you'll be required to amend your 2022 and 2023 tax returns. So you could amend, receive a refund. That all sounds great. The caution there, right? And we want to add this practical consideration. Hopefully it's practical. How long is the IRS going to take to process these refund claims? We've seen historically that it takes a while. So what we're advising clients, and what I've heard other people advising clients, is when you're looking at this overall, you should expect it to take 12 months to receive a refund. I don't think it'll be as protracted as what we've seen with some of the employee retention credit claims. I had a client today receive a refund that was claimed, I think, in 2022, right? So that's several years. I don't think we'll be on that sort of timeline, but this timing does impact your decision, right? For a lot of businesses, it might make more sense to just start adjusting their estimated tax payments, coming up here at the end of the year and into 2026, rather than waiting for refunds from the IRS.
All right, so here's your choices. For any company, as Cole's been talking through the different choices, there's no retroactive relief. You can, again, with some exceptions, but there's no retroactive relief. You follow the capitalization rules through 2024. And then there's the transition choices. You can take your remaining unamortized balances in your 2025 year, or split it between 25 and 26. And remember, this is going to be 90% of what was capitalized in 24, 70% of what was capitalized in 23, and half still of what was done in 22. So for a company that's spending $1 million a year, we're talking $2.5 million. That's just sitting on the books that you can accelerate immediately. In 2025, you do the automatic method change and go back to basically the domestic expenses were the way they were before this change happened. So we're just saying, hey, this was a 3-year blip for domestic. We're going to go back to expensing these as we incur them. So 2025, you have the potential of deducting what you spend, along with everything else still sitting on your books. For eligible small business, we've got a few extra choices. That's defined as a company with 31 million gross receipts or less in the average 3 years. You've got a couple of choices. One, you do what any size company can do, and you just make the method change for 2025, roll it forward, take it all in 25 or 26. You've got, as Cole mentioned, a retroactive election where you expense 24, and then you have to amend 22 and 23. This is, if you want to do one, you have to do all of the ones that you claimed 174 on. So you can't pick and choose 22 and 24. You have to go ahead and do all of them. One of the nice things, though, is if you already filed your return, you can supersede it. So you're not amending 24, you are superseding, and the IRS recognizes that some of these changes came kind of late in the tax filing season, and there's an extra couple of months, so into November, that companies have to do superseding returns, which is much longer than they'd normally have. And then finally, there is another option where you can just go ahead and adopt in 2024 the new method. You have to do a 3115 method change, And there's still a lot of clarification needed on this. The IRS was attempting to write really clear guidelines. Cole actually went ahead and called them and asked them some questions, and they were really proud of how hard they worked to make this clear. And it is clear as mud. It is
Not only
clear
did
as
I
mud.
call them, I called the people that drafted the revenue procedure because somebody turned and said, hey, there's a phone number on there. They a lot of times will talk to you if you pick up the phone and call them. Someone from the chief counsel's office called me back. I was able to ask questions, but I think the important context and then the takeaway here is they told me that their intent on this revenue procedure and how to make these changes and what is allowed, their intent was to be as taxpayer favorable as possible. So I think that was good context. She additionally told me that they're working on some FAQs to post, right? That maybe lay out some more real world examples. There was a couple of examples in this revenue procedure, but they've heard that more is needed. And then this is also my opportunity to add that, at almost every turn, our interactions with the IRS, the people on the ground at the IRS are positive, and they really appreciate being able to add clarification for taxpayers, because they really are attempting to do their best and provide as much guidance as they possibly can. So I think that's important to keep in mind here is that, when they put out these things, when they write these, this is a very dense revenue procedure, very complicated in interpreting it, but they have a lot of cases to cover and they really were trying to be as taxpayer favorable as possible. So I was unreasonably excited about someone from the chief counsel's office there as calling me back. I guess that's that's just an aside, but it was a good experience talking with them.
And it's actually a good example because speaking of being taxpayer friendly, the IRS recognized that for the R&D credit, almost no companies were going to be taking the 280C election to have the reduced credit. And so they are allowing, if you go back and amend, you can elect the reduced credit at that time. And so you're not going to have the downstream effects of the credit increasing. So that is another item that is definitely taxpayer favorable. All right, Cole put together some overgeneralized examples for us. So example one, the company is not an eligible small business. The expenses were capitalized for legislation per law in 22, 23, and 24. The company is not required to capitalize in 23 and can accelerate everything into 25. 25 is going to be a great year as far as reducing the tax burden.
And this is like the broadest, most, easiest case scenario as example.
Yep. Item two, the company is an eligible small business. They followed the law and they capitalized in 22 and 23. 24 has not yet been filed. And you know what? They want to go back and amend. So they're going to go ahead and not capitalize 24. And they're going to go ahead and amend 22 and 23 for refunds. This is an example of what we would expect a company that maybe is in a loss position and in the next couple of years and really could use that cash flow to use. Also, this example is a company that may not have a lot of shareholders because that's going to add a lot of cost. If you're amending the corporate return and then a bunch of shareholders, it's going to eat into those refunds pretty quickly.
This is modeling a real world example, as Ariane alluded to, and I think it's more common in a manufacturing context, and then that's where this example comes from, a manufacturing client of ours that had great years in 22 and 23. And 24 is close to break even, but they think in 25 and 26 there's going to be some pretty decent losses, or at least no liability even before you accelerate any potential R&D capitalized. So for them, even waiting a year on checks to arrive from amended returns could make a lot of sense.
And then our final example, the company is an eligible small business. They followed the law and capitalized in 22 and 23, and they went ahead and filed an extension, but then went ahead and did their filing in 2024 in May. So that company now has three choices. They can amend, they can do a superseding return for the method change that we talked about, or they can just say, you know what, we're just going to wait. We'll take it all in 2025. We'll adjust our estimated payments, and we're just going to not worry about any of this. And we're going to go ahead and follow the same example as the company in example one. We've got a couple of other companies that are in what Nicole mentioned as edge cases. And There's some of them that, hey, you may want to either look at special treatment for just 2024, or if they're small businesses, going ahead and amending for 22 and 23. But it will really depend on the facts and circumstances of each individual company on what's going to make the most sense for them. Our expectation is the overwhelming majority of companies are just going to just take it all in 2025 and flip back to the old way of doing it for domestic. Anything else to add on those examples, Cole?
No, they're great examples. Not just
All
because
right. Key takeaways. So again, eligible small businesses have, we got our third polling question is up. Do you have a plan? So hopefully a lot of our companies have been working with their tax preparers the last couple of months since the legislation came out, and then the Rev Proc came out a week and a half ago or so, almost 2 weeks now. And so a lot of companies are starting to work through the machinations of what does this mean for me? So please let us know if you've got a plan and if you want some help, and we'll be happy to reach out and talk to anyone who wants talking to. Again, eligible small businesses have a handful of choices on how they want to manage their unamortized amounts, whether it comes to amending, doing a method change, or just going ahead and sticking with 2025, taking it all. For large businesses, it's not immediate, but it is tax year 25. And so for companies that are doing an estimated payment in September, there is the benefit already that you're going to be seeing. And again, we're happy to help at least model some of these choices if anyone has questions. All right, that poll
I'm just going to slide, while people are finishing poll 3, if it's still up, detailed analysis required. Some of these things on the surface level, hopefully we've been able to make them seem a little bit more simple for you, but don't confuse tax and common sense. So sometimes there are downstream impacts or things that maybe we haven't been able to cover in detail on how some of these method changes work, etc. So, make sure that you're getting some more detailed analysis and some more detailed advice before making these types of decisions.
All right, let's move on. So Cole's going to talk to us about qualified small business stock.
All right. As if you can handle any more good news, we've got some more good news. So first, I want to set the stage of what is qualified small business stock. In section 1202, you'll hear referred to, that's the Internal Revenue Code that governs this qualified small business stock, but it allows non-corporate tax payers to exclude gain from the sale of a qualified small business. And the purpose is really to encourage investment in small C corporations in order to, invest in those companies that do, tend to create a lot of jobs in the United States and create a lot of gains for our country. So the core eligibility requirements, some of these are unchanged in HR1. Some of them were adjusted favorably, which we'll get to a chart in a couple of minutes that covers that. But the core eligibility requirements are that it has to be the stock of a domestic C corporation. The stock that is looking to receive the QSBS treatment has to be acquired at original issuance. So can't be floating around in the secondary market somewhere or acquired, in some way other than through that original direct issuance. And the issuer itself must be a qualified small business. We'll get into that in a minute. The qualified small business must meet the active trader business test, basically using 80% of the assets productively in that endeavor. And previously, the stock that was you're looking to receive the qualified small business stock treatment on had to be held for 5 or more years. And that's going to be a bit of a change that we'll walk you through here in a second. Important to point out some ineligible entities. So this exclusion is not available for this laundry list.
Alphabet, you call it an alphabet soup.
Yeah, I'll let this just wash over you for a minute. But this is the historical list. If you do any other reading about QSBS or digging into the code, this is the list that has existed and really has gone unchanged for 30 years now.
Yeah, because 93 was in fact 30 years ago.
But fact. So look at this original issuance rule, right? The stock has to be acquired for cash, property, or services. So it has to come directly from the corporation. And again, talking about it, it cannot be purchased anywhere on the secondary market. So there are a few ways that you can acquire this stock, a few ways that it can, accrue to an individual. But there's some clear exceptions about who cannot get and how is where they cannot get that treatment. Okay, so what is the QSBS? What is qualified small business? The qualified small business test, primarily the gross asset test. So prior to HR1, there was a $50 million gross asset test. So the QSBS had to have 50 million in gross assets at all times before issuance.
Less than that.
Thank you. Sorry, that would be that was a bad error. Thank you for that correction. We're $50 million immediately after the issuance. So, this includes capital raises. I think we'll get into it here in a minute, but this $50 million threshold really started to come into play for some clients that were raising money in 2023 and 2023 and 2024, and we're no longer able to expense all of their R&D in current periods. Also important to note that the stock retains its QSB treatment as of the date of issuance, even if the corporation later exceeds $50 million. So if you were in a seed round, or you were in the first round, you were in a Series B, and the corporation didn't exceed that $50 million asset threshold, you still receive your QSBS treatment. It's only investors or portions of stock that were acquired at later issuance after that $50 million cap was breached that would not be treated, would not receive the qualified small business stock treatment. So important to know that.
And also, if you again go past that threshold, there's no going back. Once you've hit that, we've got a client that, with the combination of 174 and an investment round, hit 52, and then they spent a bunch of money and they were down below it again. But once you go through that door is shut. Yeah.
So I think Jeff Bezos would call it a one-way door. Once you go through that door, there's no going back. Yeah, I'll just leave it there. Active business requirement. 80% of the assets must be used in the qualified trader business. And there's some exclusions for certain fields and certain industries that cannot have qualified small business treatment. So it excludes things like law firms, accounting firms, consulting, finance, hospitality. There's a longer list, but we didn't want to give you the whole rundown of those. But important to keep in mind, we can't split off and start an accounting firm and then sell it and get QSBS treatment. Just won't hold water.
All right, let's talk about what's changed. If I can get these slides to advance, there we go.
All right, so the aggregate gross threshold test, right? We just covered the $50 million. So then on the right side column, after OBBBA or HR1, that changes to $75 million. So making that adjustment, that $50 million cap has been there, I think, since 1993. But now they're adjusting that cap up to 75 million. And then the other exciting thing, the other exciting part of these QSBS changes is that there'll be an inflation adjustment starting in 2027. So that $75 million cap will continually be adjusted for inflation the way a lot of other tax items are adjusted. Previously, that holding period was 5 years. We mentioned that. Now, under the HR1 treatment, you're able to receive some QSBS benefit after only 3 years. So, previously I had to hold it for 5 years. There was a bit of a change back in 2009, 2010, but most of those years are well in the past for a lot of investors in these corporations. So what to think about now is that if you hold the stock for 3 years, you can receive 50% of your QSBS exclusion treatment. If you hold it for 4 years, that steps up to 75%. And if you hold it for 5 years, right, what was considered previously the full holding period, you get to utilize 100% of that gain exclusion. And then there's been an increase in the gain in per issuer gain exclusion limit. So it was previously $10 million. It's been moved up, or effective 7/4/25, it would be moved up to 15 million. And again, another exciting part here is that there's now going to be an inflation adjustment going forward starting in 2027. And that was always a complaint, if you will, or an observation with QSBS. It was one of the things in the tax code that wasn't adjusted for inflation, right? So when this first came into play, you know, it was a certain threshold, but you know, $10 million is still $10 million, right? You'd love to have preferential tax treatment on that $10 million, but wasn't quite as powerful as it had once been.
Yeah,
So
erosion, the inflation effect has eroded some of the value.
It's going to go a long way towards incentivizing that. And then we mentioned there's another limitation in there. It's actually a little more complex than we've been able to detail on this slide. But the important takeaway here is the per issuer gain exclusion has increased quite a bit and will index for inflation. So grandfather rules, or maybe no grandfather rules, basically pre-HR1 stock issued before July 4th retains its old Section 1202 rules. There's no retroactive treatment of these Section 1202 changes. So you can't convert either, right? You can't convert old shares into new ones and receive this new treatment. Important to keep in mind, each block of stock that you might possess or that has been issued needs to be tracked separately for basis, holding period, exclusion percentages, etc. Right? Different things now could apply, different thresholds, different standards could apply to various blocks of stock. So it becomes incredibly important if you hold pre and post HR1 QSBS to maintain careful records and make sure that the rules are applied carefully. So, in summary, if you're planning, poll 4, launching, just asking if you'd like to talk with me more. I don't know how anybody would answer no, but so go ahead and answer poll 4 if you want CPE. Give you a second there. But anyway, let's talk about planning and pre-investment considerations. So am I going to take advantage? Am I going to be able to benefit from the Section 1202 qualified small business stock? Well, am I planning on holding the stock for 3 to 5 years? That would be important. If for some reason I'm not planning on holding it for that long, is really not a consideration. You know, was the asset value post HR1 less than $75 million, or was it less than $75 million post HR1? Also, the fourth bullet point, double taxation. It's important to consider if you're setting up the entity, what the long-term plan is and what the overall tax ramifications may be. While qualified small business stock treatment is great, there are situations where it could make sense to forego being able to claim the Section 1202 QSBS treatment. So it's just important to have detailed individual analysis on that front, you know, investor base, non-corporate taxpayers. And then it's something that management has to keep an eye on. So a lot of times this comes into play when companies are raising money, right? Is it going to qualify under Section 1202? It's important that management understand whether or not it will and why it does and document that it does. So a key takeaway here is that we just need to maintain the documentation, right? There's so many things and all things tax, maintain the documentation, right? Monitor asset levels and corporate structure, get someone involved that is a real expert in this area, because there are a lot of ways to, you know, go afoul of these rules. And candidly, we've done a pretty high level treatment, though we've highlighted the key changes, but there are a lot of, down in the weeds details that need to be considered when we're talking about a preferential tax treatment of this, potentially of this size. It's very impactful.
So before we get to the next slide, if anyone does have any questions, please push those into the Q&A. We've got one more bonus topic, and then if there are any questions, we're happy to get to any of those, and we'll reach out separately if we don't get to all of them, or if you ask a question that's detailed enough that requires a bit more treatment than is probably well done in this type of setting. We're happy to set up a call for afterwards. So as we talked about, one more thing.
Let me do my talk up. One more thing. Everybody's got to get the context is that I put added this at the last minute while the Apple event was going on yesterday. Maybe not as impactful as the old Steve Jobs one more things, but in the world that Ariane and I live, the R&D tax credit, right? It's important to get this in front of everyone, these disclosure changes that are going to hit us for 2025.
So we've been watching this issue for a while, along with watching Section 174 as it, didn't progress. The IRS has been hinting at and then talking about changes to what they want to see on the 6765, the federal form that is used to claim the R&D tax credit. The 2024 year did not require these disclosures in any great amount, but it did actually show what they were and just made the really big mess of disclosures optional. The reason the IRS is doing this is there's a handful of reasons. One, it's some extra information about key issues that could lead to either the R&D credit being calculated incorrectly or just greater risk of issues. So things like control groups, buying and selling a company, new categories are things that are getting asked about. And they're also asking a question around owners. So if you've got an owner who is participating in R&D, they want to know how much of the expenses are due to that owner, which again, fairly reasonable to make sure you don't have someone with excessive compensation getting included at those excessive amounts. It really helps because you've got a consistent and predefined format. So the IRS is asking everyone the same question and hopefully getting answers put together the same way, which makes it easier for review. As a taxpayer, this is actually really good as it helps, again, if you're asking these detailed questions, people who have junk claims are going to have a tougher time just jumping through the hoops of getting the paperwork done. It does increase the burden for all taxpayers who are looking to claim this credit. But as someone who does pay taxes, I do appreciate that they're working on making sure that the resources are focused on the ones who are more likely to be potentially improperly claimed. And there's a handful of other questions around what kind of activities are getting done. And so the IRS has doubled the length of the form. It used to be a 2-page form, and now it's a 4-page form asking for what's called allocation by business component, which is the IRS's fancy word for project. And they're asking, say, hey, we want to see your wages allocated out by business component. We want to see your supplies. We want to see your computer rental, and we want to see your contractors. We want to see those allocated out like by the projects. And there's some limits to those as far as what they're expecting to see. So companies that are below 50 million in revenue and $1.5 million in expenses will not have to jump through the extra paperwork hoops. However, the IRS expects that information to be on hand. So if you are a smaller company that is not required to report and they have questions, that's probably the first set of questions. Hey, provide us with the detail of this. We know you didn't have to on the form, but now we want to see it to make sure you have it. The IRS basically considers this information every taxpayer should have been collecting anyway. Our experience with a lot of smaller taxpayers is they don't. And so this has been a big change for a lot of our clients in figuring out how to reasonably capture this information and allocate costs from the data that's available into the format the IRS wants. And so that's been one of our big projects for this year and going into the filing season for 25.
Yeah, so Ariane, where are you seeing the biggest headaches still with clients having the information organized in the right way?
So the biggest challenge that I'm seeing is if companies aren't doing time tracking and they have a lot of projects, is figuring out how to allocate employee time against those projects and just defining a project, honestly. So if you've got a software company that has worked on 60 different things, do you really want to figure out how to allocate against 60 different projects? Or do you want to design your business components to be initiatives and to get that down to, again, if there's clear, distinct ways to say, hey, all of this is in one group of activities, we're going to call this one set. The other really big opportunity for improvement I see is, especially in manufacturing where you're making discrete items, is allocating your supply and outside contractor expenses and just tracking. Is this for project A, project B, project C, et cetera? And figuring out a way to say, hey, this expense goes with this project, instead of just having everything in an R&D bucket. And I think those are the two biggest areas of opportunity, and the biggest challenges we're going to see with a number of our clients is just saying, hey, this cost goes with this project.
Yeah.
Good question.
The supply one was the one that I wanted to hear you talk about, right? Because, I think with our clients, we've done a good job of starting to allocate out by business component over the last couple of years, but it can be difficult to transition from, we're going to put, potentially tens, hundreds of thousands, millions of dollars worth of supply expense into an R&D material bucket, for instance, to now have to transition to, well, in order to claim that as a supply expense for the R&D credit, or the Section 41 credit, we now have to be able to allocate that on the tax form to the component level, right? And that's a significant change. And I would say, if you have a big bucket of expenses still sitting here on September 10th, it's never too late to make the change for 2025, right? Any additional detail that can be added, right? Even if it's just for the last quarter of the year, that gives additional data for the last quarter of the year that we could potentially use to get to the bottom of allocating out those expenses for the entire year.
Yep. And for companies with lots of projects, the IRS is requiring, again, if you have to complete the paperwork, you have to do the top 50 by expense, or you just have to go down to 80% of the dollars. And so there will be, and then everything else that's listed as a single line item. So there is a concession to the fact that some of these enormous companies might have 6,000 projects, and they're not asking and expecting 6,000 discrete lines, but there is expectations of tracking, and that data needs to be available upon request. You're just not having to jump through the hoops of the paperwork.
However, 2 years ago, they were saying that was their expectation.
They have definitely, the team over at the IRS has definitely had enough conversations with people who said, hey, that's not reasonable, and has shifted their position to a much more reasonable spot. There are no open questions in the Q&A. Does anyone have anything else? I think we're just about to hit time here. That's to make sure that we hit our CPE. We did get one vote for classic rock on intro music, by the way.
Good.
Which is, I think 90s alternative is rapidly approaching classic rock. So
yeah, well, on the next webinar, we'll ask question people to define classic rock. So we'll do that next time. So with that, I think that's everything. Hopefully we've given you a good flavor of what these changes are and how they can impact your business. Of course, we'd always be happy to chat with you about it in more detail. So
this is Cole's contact information. If I get looped in, I'm happy to join you. Jay continues to answer yes. But
I was just going to add that if you're interested in talking about qualified small business stock, I probably also have a counterpart of mine who's a little more of the technical expert, Mian Taj. She's our expert on qualified small business stock. So we would definitely be open to conversations with people as well if they want to discuss that topic.
So.
Well, get a hold of me and I'll get it coordinated.
Yep. So, well, thank you everyone for attending. Have a great rest of your day.
Thanks, everybody.